Thank you everyone for coming to our second speaker series in the year of 2012, the European Sovereign Debt Crisis and its effect on Main Street. We have three incredible speakers with us. Dean Policano from the UCI Mirage School of Business. He recently published a book which is already sold out on Amazon. It's called Public No More. In every magazine and metric, their MBA program.
I should say own 25 copies on Amazon.
He's done a fabulous job of growing the business school and helping our community. I've been to his seminars a couple times and been blown away by his presentation, and we're very thankful for his involvement in this event today. We also have David Fisher from PIMCO. He's Vice President, Product Manager in the Newport Beach office, handling global fixed investments. He's an amazing speaker as well. And then we have Jim Negus from KPMG. He's a partner and practice leader for their finance, treasury, and capital markets practice. He's a partner in charge for all the states west of the Mississippi for their global consulting practice. So I could not be more thrilled to have them present with us. And by the way, they're all volunteering their time for us. OCYE is a volunteer organization. We're trying to help the community, and through our partnership with Bank of America Merrill Lynch, Northwestern Mutual, we're able to raise money through these events for a scholarship that would be applied at the end of the year. It's called our OCYE Future Leaders Scholarship Fund. And we're hopeful that through these events and support and building awareness for important issues like we're presenting today, that we'll be able to provide a full scholarship for a student at the end of the year. Come to our holiday party, we'll find out. So without further ado, I'd like to immediately start with David. Thank you so much.
I'm going to give a brief overview of what's happened in Europe and the implications that we at PIMCO see for Main Street, the U.S. more broadly, of what's happening in Europe. Because we do think that the events in Europe are actually some of the most important events that you as business leaders or even as individuals need to pay attention to in the months ahead. So the threat, the Eurozone clearly struggling under a very large burden of debt, particularly the peripheral countries that I'm sure you've heard a lot of talk about in the news lately. There has been a limited amount of policy response to address liquidity issues, but this has failed to address the underlying solvency problems within the Eurozone. And that leads to a situation where global risks are quite large and substantial. So as you can see at the bottom, our forecast is for June gloom, the only difference, of course, being that in this case you don't have the promise of a nice sunny afternoon. In this case, it's going to be cloudy all day long throughout the month of June, in our view. So what's the problem that we see in Europe? At the end of the day, debt is really the issue. This chart here shows the massive buildup in debt that we saw in many European countries in the lead up to the financial crisis. This buildup in debt, and what we're looking at is the change in overall debt in each of these economies. This was largely responsible for the rapid growth we saw in many countries, including the U.S., in the years leading up to the financial crisis. Growth in credit, generally good for the economy. But of course it leads to a pretty significant buildup in the overall debt levels. Since the crisis, the blue lines here, these blue bars, show the change in debt since 2008. And what's striking, I think, is that aside from the U.S., where you see a very small negative, small reduction in debt since the crisis, European countries, for the most part, have actually continued to see their debt levels increase. So you had a huge buildup in debt pre-crisis. Since the crisis, you haven't really seen debt come down very much. Importantly, however, the composition of these blue bars is a little bit different than the composition of the gold bars. The gold bars were largely driven by a rapid growth in private sector credit, corporate or individual borrowing, much like we saw here in the U.S. The blue bars actually represent a combination of two things: private sector debt reduction and public sector increases in borrowing. So what that's led to is a very important increase in the level of sovereign debt, of government debt in many Eurozone countries. And you can see that on this chart here where we're showing debt to GDP levels over time, since the crisis in 2008. And you can see that these debt levels have actually increased at a pretty remarkable pace. Now, of course, the big problem child for Europe is this gold line at the top. That's Greece. Greece is, you might call it a lost cause, but I would highlight that some other, many more important sort of key countries for Europe are also facing very significant debt problems. So basically, the fact that governments have tried to offset the decrease in borrowing, the deleveraging of the private sector, has created a very significant sovereign debt problem in Europe. As I mentioned at the outset, there has been a policy response. This has largely come from the European Central Bank, or the ECB. The ECB has responded in two ways. One was by directly purchasing sovereign debt, although they've done that in a limited fashion. You might call that quantitative easing, much like we've done here, like they've done in Japan for many years, like they've been doing in the UK as well. But their biggest effort has been what we call the LTRO, or long-term repo operations, where they've been lending money to the banks. And you can see the impact of their lending to the banks in this blue line here, which shows the balance sheet of the central bank, the size of the central bank's assets relative to the size of the economy. So even though they haven't embarked on, again, this QE, quantitative easing, like the Fed and the Bank of England have, their balance sheet is actually much larger as a percentage of GDP than the balance sheets of either the Fed or the Bank of England. So you've seen a massive injection of liquidity into the system. This liquidity has been used by the banks in many cases, particularly in the case of Italy and Spain, these two bars on the right here, to buy sovereign debt. Right? So not only have the banks seen the liquidity come into their own balance sheets, which helped them finance their own maturing debt, because one of the challenges was that nobody wanted to lend to the banks in Europe. So the ECB lent them money, which solved that problem. But the other problem was that no one wanted to lend to the Italian or Spanish governments either. So the fact that the banks were willing to take the loans from the ECB and buy government bonds, as you can see, they bought almost 70 billion euros in the months between December and February in the case of Spain, and over 50 billion in the case of Italy. This massive purchase of government bonds had an important impact on the market. It helped to bring down the yields on government bonds for, in particular, Italy and Spain. So we call this period here, though, the LTRO sugar high. Right? And as everyone knows, a sugar high doesn't last very long. And in fact, usually when you have a sugar high, that leads to a pretty big crash. That's unfortunately where we are right now. The LTRO sugar high lasted really through February, maybe early March, where you saw the impact of this liquidity helping bring spreads in. But subsequent to that, and this chart unfortunately doesn't go through today. If it did, you might not be able to digest your breakfast, but these spreads are significantly wider today, and that's why we're facing a situation today. When I say today, I mean today, in Europe, where we need a policy response immediately, or things are going to go pear-shaped pretty quickly. So the fact that liquidity was put in the system was a good thing, but it wasn't enough. The reason that it wasn't enough is that liquidity injections don't necessarily address underlying structural problems or long-term solvency issues. This chart here, and it's a little bit wonky, so I apologize for that, but it shows the change in unit labor costs, essentially the amount it costs to hire workers or pay workers in various countries around Europe in the period from March 2000 to March 2011. So essentially, this is how much labor costs have increased. in Germany, over this 11-year period, labor costs have increased by 5%. Right? And this is essentially a measure of real labor costs. Very, very marginal increase in labor costs in Germany. In other words, German workers have been willing to accept very limited wage increases in order to promote the economy. Meanwhile, Greek workers have seen a 35% increase in pay, essentially. This differential, 30% versus 5%, is essentially the problem. That's the underlying challenge in Europe. Greek workers, of course, haven't become 30% more productive than German workers. They might become 30% less productive, but certainly not 30% more productive over this period than German workers. So they've essentially priced themselves out of the market. This has created a challenge for the current account, essentially the trade balance within Europe between countries. So these charts, these lines here, show the current account balances for the peripheral countries within Europe, and then the dotted line here shows the current account balance for the Eurozone as a whole. And as you can see, unlike the US, the Eurozone actually runs pretty much a current account balance. In other words, they're exporting just about as much as they're importing. Again, very different story than the US. But the composition of this line is essentially a couple of countries up here that are running huge trade surpluses, Germany being the most prominent among them, and then a whole group of countries down here that have been running huge trade deficits. And it's really this labor cost challenge, right, this competitiveness issue, that is the reason that explains why these countries are running these massive trade deficits. So the fact that the labor cost adjustment has not been addressed means that these current account deficits are likely to persist for some time. And that, again, is at the heart of the problem in terms of adjustment. A current account deficit requires a capital account surplus. In other words, if they're buying more stuff than they're selling, then someone needs to lend them the money to buy that stuff. The private sector, individuals or banks, are no longer lending them the money. The only people lending them the money really are the European Central Bank. That's not a sustainable situation longer term. Now, the other big issue, of course, I mentioned debt at the outset, is that fiscal deficits are a big problem. So again, I mentioned that private sectors have been deleveraging throughout Europe since the crisis. The public sector has been re-leveraging. Basically, the way the public sector levers itself up is by running a fiscal deficit. And as you can see, in many countries within Europe, these fiscal deficits are pretty enormous. I would note, as an aside, that our deficit isn't looking too great relative to theirs. But we fortunately have some advantages that these countries don't have. In the case of these European countries, these peripheral countries, these deficits certainly need to come down. They're not sustainable longer term. The problem is that if you address this deficit, in other words, you reduce government spending in an environment where the private sector is also trying to rebuild balance sheets, where consumers are saving, banks are trying to reduce the size of their balance sheet, companies are hoarding cash, then you end up in the situation where unemployment skyrockets. So the fiscal deficits right now are offsetting this private sector deleveraging. Even though they are doing that, you're still seeing unemployment rates rise. In other words, growth is a big underlying problem in Europe. This shows Spanish unemployment, nearing 25%. Youth unemployment in Spain is about 50%. So half of the youth in the country who want jobs can't get them. So there's clearly a huge underlying economic problem in Europe. Addressing the fiscal deficits today, which is essentially what Germany is saying to the rest of Europe, they're saying, you need to be more like us, right? You need to save rather than spend, will make this problem even worse. And this is really at the heart of the debate between the core countries and the peripheral countries. The peripheral countries are saying, we can't take any more pain. We've got too much unemployment. Our economies are in recession, much more so than the German economy. The Germans are saying, 9. Yeah? We won't listen. No, no, no. They're saying, you've got to cut. You've got to become more like us. Now, one of the biggest challenges, and this is where growth comes in, and why I think that the Germans eventually are going to have to cry uncle or admit that they've lost this argument, is that what drives debt, those numbers I showed at the beginning, is two things. Debt can increase either because you're running a fiscal deficit, right? If you run a fiscal deficit of 8% of GDP, then your debt to GDP is going to increase by somewhere around 8% of GDP from this year to next year. So fiscal deficits are one way to lead to higher debt to GDP. So the Germans are basically saying, well, cut those deficits. If you cut your deficits, then your debt to GDP will stabilize. The challenge is that the other factor that impacts the level of your debt to GDP is this one over here. That's how much debt you have right now, roughly multiplied by a term that's the yield, the borrowing cost that you pay on your debt, minus nominal GDP growth, the growth of your economy in nominal terms. This term here, the yield minus the GDP growth rate, we call the snowball term. We call it the snowball term because even if you can address your deficit problem, even if you run a primary balance, in other words, the government is spending just as much as it's taking in, its debt can snowball if yields are too high and growth is too low. And this is the situation we're in right now. The blue line here shows borrowing costs, and again, this is an updated to the latest data. That line would be even higher now. The gold line shows the nominal growth rate. And here we're giving the example of Spain, but the chart doesn't look too dissimilar for a country like Italy. The red here shows the difference between those two. So in other words, if growth is here and borrowing costs are here, that's a negative number. And you can see that for most of the period of EMU, this has been relatively in balance, right? There hasn't been much of a snowballing. The last time we saw this inversion where growth rates were so far below borrowing costs was back in the early 90s. And I think somehow actually the dates are missing from this chart. But this is the early 90s, actually 92, 93. And for those of you who remember the ERM, the early stages of European integration, there was what's called the exchange rate mechanism in Europe at this point. There was a fixed exchange rate between countries. During the early 90s, this blew up. The main reason it blew up is because of this red area here, right? That area on the chart. That basically growth was too weak in the peripheral countries, Spain, Italy, and others, and borrowing costs were too high. So these currencies had to devalue. Today, these countries don't have the option, or, well, at least not right now, the option of devaluing their currencies because they're all in the euro. This is the heart of the challenge and the heart of the debate between Germany and the peripheral countries. Okay, so with that rosy background, what do we think is the outlook for the Eurozone? The bottom line is at the end of the day, we think that what we're calling a smaller, less imperfect Eurozone is the most likely outcome. There is a possibility of an intact Eurozone, even including Greece, that you might call the United States of Europe. That would be fiscally integrated like the United States is, with central taxation and borrowing, centralized political union, but would also, of course, require a shared vision, which I think is the thing that's really lacking right now. Right now you've got 17 different visions in Europe of what it should look like. But you could see this situation in the most positive potential scenario, which is becoming less and less likely by the day. We might put a 1% probability on that right now, that Greece stays within the Eurozone. But it's still it's a possibility, right? It's not impossible. More likely, well actually, let me move to this one down here before I come back to that so I don't end on such a sour note. The negative outcome, and the one that is becoming more and more likely as days go by and as policy responses continue to be lacking, is complete dissolution of the Eurozone, a fragmentation of the Eurozone, and basically, we're coming back to 17 new currencies. So in addition to what we're calling the euro, a new Greek currency, or Greek drachma, you would have the peseta, you'd have the Italian lira, and of course you'd have a new German mark. So Would this happen in orderly fashion? No. I mean, there's no way that you could plan for this. This will happen because people don't do anything to stop it. So it will be a very disorderly outcome. There will be defaults across the peripheral countries. It will be complete chaos within the Eurozone. And very importantly for all of you, it'll be pretty much complete chaos, we think, on a global basis. And this is why it's important to pay attention to what's happening in Europe, because if we end up in this kind of situation, I think there are going to be severe impacts on growth, not only in Europe, where we'll see a massive recession, but also here in the U.S., where we do certainly rely on what little demand there is in Europe for our own economic future. So significant pain across the continent and globally. I guess what our base case is still our most likely scenario, but one which is facing increasing challenges, is this one in the middle, the smaller and less imperfect Eurozone. This is one that we still think is possible, but again, it also requires that the visions of these various political leaders, particularly the difference of opinion between the German and the Spanish and the Italian, narrows quite significantly over the next days, weeks, and months. In other words, they need to come together very quickly to agree on a solution, because if they don't, again, this is where they're likely to go. I've listed a couple of the policy tools. I've mentioned some of these. There are a variety of things that could be done. All of them essentially lead towards more fiscal integration of the Eurozone. That's ultimately what we need to happen. We can't have a monetary union without some sort of fiscal and political union. So these various things need to happen. But right now, there's very little movement in our view towards coming up with these solutions using these tools. So what's the outlook? So rock bottom interest rates. We don't think that interest rates are going up anytime soon. We've been talking, I'm sure you've heard a lot about U.S. Treasury yields. The 10-year note is now below 1.5%. That's a record low, not a record low since 1980 or 1970 or 1960. This is a record low. Even in World War II, rates were really not this low. So we're talking low by any stretch of the imagination. I would highlight, however, German Bund yields are below 1.2%. And we all know about Japan. Japanese interest rates at 10 years are around 80 basis points. Does anyone know where Swiss 10-year interest rates are right now? 0.5%, 50 basis points. So even lower than Japanese rates right now. That's because everybody wants to get out of the euro. They look at the U.S. and they say, oh, the U.S. has its own problems. They want to go to Switzerland, right? Everyone knows Switzerland is safe, right? So they want to buy Swiss assets. 50 basis points for 10 years. If you want to invest in a Swiss government bond for 5 years or less, you have to pay the government. You have to pay them to buy their bond. Now that's crazy. But that's the world we live in. And we think that rock bottom interest rates are here to stay. We also think greater volatility is here to stay. I think the volatility in the stock market today, you could argue, is driven by our own problems. The fact that our economy is a little bit weak. We saw a pretty weak employment and unemployment report today. But Europe is likely to be a source of very significant volatility, and we think that's something that's not going to change. And certainly in the next weeks and months, this summer is going to be fairly rough. So get ready for volatility. And then very importantly, we think this is something that as investors you need to become more comfortable with, is the idea that returns for all asset classes are likely to be lower in this environment. Partly because interest rates are very low, but also because we think growth rates are going to be low. And if growth rates are low, it's very difficult to grow profits. If it's hard to grow profits, it's hard to grow prices of equity. So all types of asset classes, we think, are going to deliver lower returns. And that's something that I think, as investors, you need to get used to. There's a famous quote that John Maynard Keynes, a famous British economist of the 20th century, that apparently in response to a question about him changing his mind, he said, well, when the facts change, I change my mind. What do you do, sir? And I say that it's generally attributed to Keynes because there's actually a lot of debate about whether he said it. One person who was looking into the question of whether he said it remarked that, like Mark Twain and many others, Albert Einstein, he seems to have said, Keynes seems to have said a lot more clever things after he died than he did while he was alive. But whether he said it and whether he was alive or dead at the time, I think is actually irrelevant. The most important thing to note is that the facts have changed, and Europe is one of the facts that's changed on the ground. And we think that means that as investors, as business owners here in Orange County, that means that you need to change the way you think about the world. So keep an eye on the screens. Again, June gloom is our outlook, and probably with a chance of afternoon showers rather than afternoon sun. So with that, I will pass it along to you.